Hi, everyone. I'm Rick Bensignor. Today is Tuesday, December 7th, and welcome to this week's In the No Trader Show. Well, markets are flying today. The S&P is up 90 points or so. That's a good solid 2%. Oil's up probably 4.5%, 5% or so, as markets have recovered, at least temporarily, from Omicron fears. Today and yesterday show that buyers have been around, and it doesn't take much to push this higher when you get too many people leaning negatively. Last week, statistics showed that the AAII poll had the most amount of bears for 2021. And that was just one of the contrary indicators to potentially suggest, didn't mean it had to, but at least you know there's a lot of people who have sold out. And in theory, people talk their position. So if they're bearish, it assumes that they had done some selling, and we're looking for lower prices. Let's take a look what we've got on tap for this week. In trader education, we're going to do a little segment called When There's Blood in the Streets. In our market overview, we'll take a look at Dow Jones, the US 10-year, and the US dollar. And then this week, we'll take a look at utilities. I'll show you in a second why we'll take a look at utilities. But it's a sector we haven't looked at in a while, so we'll take a gander at them. Just some information about the products I have. We have a weekly ETF Tactical Trader Report, generally scheduled for Thursday release, Thursday evening. Sometimes comes out over the weekend when I feel like there's enough volatility and I want to see how the market ends the week. So for the last couple of weeks, we've put it out on Saturday rather than Thursday, but it is a once a week product that gives you a very deep view of macro. We always take a look at bonds, credit spreads, usually the dollar, gold perhaps, and kind of a deep dive into the S&P. Then I give you a new ETF trading idea for the week and go over all open positions that we have until they get closed out. You can find information for that on inthenotrader.com. Sign up is on the sign up tab. And also the monthly 7-Eleven Spider Sector ETF report. That's a report designed to beat the S&P 500. It has done that handsomely so far. This year, we are up, I don't know, I think it's, trying to remember, maybe 1.7% or so we're outperforming. And since we started this in August of 2020, what is that, 16 months ago or so, we have outperformed now by 4.94%. So we outperformed by another 50 bips in November and 4.94. So for those of you who are investing in spiders, I can tell you that you are better off if you listen to what we tell you to do and the allocations we make to less than 5 and more than 7 of the 11 spider sectors each month. And as I say, we have very nicely beaten the S&P's results. Again, sign up for that in thenotrader.com. Okay, let's talk about the idea of when there's blood in the streets. And the reason I say this is that in this bull market, we've gotten several times that we've sold off. In the last year, the most we've sold off is 5.5% or so. That was in the September decline. We got about 5% or so on this decline before we have this massive 2-day rally. And it usually presents some opportunities if you have, and here's the thing, if you have resting orders in names that you want to buy below current price, that in a market sell-off, you may be able to get a chance to get an opportunity to get in at a level that you've been hoping the stock or ETF or whatever it is you're trading would pull back to in that type of event. So as a rule of thumb, I have names that I want to own on market pullbacks, but I certainly can't go through every stock every time the market sells off. And you know, when the market gets crazy as it's been for the last 2 weeks, it's very easy to get lost into doing some deep analysis on something, and it takes a lot of time. And what happens is, if you don't have some resting buy orders in place, sometimes for months, at levels that if the market pulled back to, you'd be very happy to take it, you often miss the chance because you're just looking at so much that's going on at the time. So here, let's go to charts. So here's Twitter. And obviously it's been rocked recently. So it fell from 60 down to the low 40s, a huge decline. And this is with, you know, no indicators on. But if I look at prior lows, I see that we have something down here. Where is this? This is at 44.40. This is at 39-ish. So somewhere perhaps in the low 40s, you have some support from going back for over a year. So I might know, maybe somewhere in here, I'd be interested. Totally unrelated, when I put on the propulsion model from DeMark, it had a level here at 41.70 that's been in place since July as a downside target if the market kept selling off. Now, it did break through this level, the propulsion momentum level, properly, turn this into little triangles instead of a solid line, targeting this level. And sure enough, in early October, on the end of the decline, it touches right down there and rallies back up. So a place you could have bought. But I had a bid down here at 41.70, and I think I made it 41.80 just to make sure that I didn't want to play too cutesy with this, because somewhere down in here, I figured, let me take, if the market gave me the chance to do it, let me be a buyer. And I was able to get filled a few days ago because we got down to, look, the low is 41.75. If I had left my bid at the exact propulsion level at 41.70, I would have missed it by a nickel. And now it's up almost $5 from there. So I think I put it in at 41.80, maybe 41.82, something down there. This one I was able to get. I'll show you one that I just missed, and I've had this bid in since September, which was Boeing. And interestingly, Boeing's not something I had looked at on this decline. I just remember I had a bid in at 186, I think it was 186.01 or 186.02. I see that I missed it. This low was down at 191. Now let's see, where did we get down to? We got down to 188. So by $2, I missed this one. This really tested this low from February, which was the 2021 low, and came right back up. I don't even remember what had me bidding precisely 186.02, but this one I missed by $1 or $2. But there's a point to this, and I'm not going to spend a lot more time on it. The point is, have resting bids underneath market levels that you're comfortable buying a stock if the opportunity came. If you remember back in 2010, we had a flash crash, and that was a huge down day. I think it was May 5th or 10th. And a lot of opportunities were given to people who had resting bids. You're never in real time going to likely do this and catch a falling knife. You kind of have to know your levels beforehand. So just, you know, a couple of examples. One I was able to get, one I just missed, but I've got resting GTC, good till cancel orders on several names. If the opportunity came that I could get in at a level that I was very willing to get in at. And so that's today's little trader education portion, is put resting bids in underneath current levels, well underneath, should something happen that the market gives you a chance to get in at a level that you're very comfortable taking ownership of that particular security. So that's that. All right, let's go back to this, and we'll take a look at the Dow, the TNX, the dollar index, and then utilities. And why utilities? Well, here is the results through last night of trading that resumed the day after Thanksgiving through last night's close. This is the 11 sectors of the S&P plus the spider itself, and seeing the result. Coming into today, the S&P was down 2.27%. Consumer discretionary has gotten the worst of it, down 3.75%, followed by financials, which are down 3.72%. Only one sector has been up since, we'll call it the Thanksgiving massacre, and that's utilities. And of course, utilities have been a big laggard year to date, but they're a safety trade, and they were up. Now, today, it's probably going to unwind a fair amount of this. You're going to see that these heavily beaten up ones are probably bouncing nicely, and I'm guessing utilities is down. But let's take a look at the utility sector when we go through the sector portion, just to see if there's some bargains there. If people are bidding into them, are these just bids out of pure safety, or have these potentially reached levels that are good buys in some of the names? And it's funny, when I look at my own portfolio, I realize how few utilities I own. It's just not a sector I've ever really paid a heck of a lot of attention to. And occasionally you get these years that utilities outperform, but it's very far to between. It's truly a defensive sector. And I tend to be more in the growthy parts of the market. So I don't know a lot about utilities, and that's part of it, but it's also just not a sector over time that's performed admirably. All right, so let's get to some charts on these. We'll start with, let's get to the Dow Jones, the 10-year, and the dollar, and then we'll get to these individual names. So the Dow Jones weekly chart, we showed you this last week. Dow came down to, look how low this got, right against June's lows, right against the top of the weekly cloud. Intra-week, it broke the two uptrend lines. Notice where it closed above. That's a full test and bounce off of the major support level. And now we're up and flying, and 1,000 points or so away from all-time highs, less than that even. So significant move, bounce on support. Even the type thing too that, you could put resting bids either in the Dow itself or in component names. You'd have to look through those 30 names, but see if anything, showed up that if we had a plunk down to known support, you had a chance to get into something. I look at this chart, obviously it's recovered and bullish. There is something I've learned over the years with cloud charts is that often when you go sideways in a bull market, the bull market will once again continue when you hit the cloud, the top of the cloud, and things turn around and start going back up again. So this is actually a fairly bullish looking chart. There is, in theory, some resistance right around where we are now at 35,653. We are 100 points above that, but we're still early in the week. It'll be be interesting to see if this keeps going. Upside target would be 37,300, 37,300 if this keeps going. But we may stall in here over the next couple of days. We'll see, because the market certainly would have shaken out virtually all the shorts that would have come in since that Thanksgiving massacre. Let's take a look at the 10-year. So here's the US 10-year. This is now holding on trendline support from the July 2020 lows. It's not the all-time low. The all-time low was just beneath there. The highlighted yellow box is the Fibonacci box. So that's the 38 to 62% retracement, but we're not down there yet. So this, for the time being, is still holding on after you really have a whole area of kind of a double top, both associated to set up 9 counts. The counter low in between was a setup 9 down, and we're still in actually a downward count as of now. So this 9 count creates the chance to do a 13 higher. So we're 4 towards a 13 on the upside. In the setup count is also, there's a new one towards the downside, which is a 4. As long as this week closes beneath the close of 4 bars back, which is 15.82 in TNX terms. It stays at 4. Next week would be a 5, as long as it closes beneath bar 1's close, 15.36, and so on. So you still have near-term negative bias, but it is bouncing into both where it broke out from as well as the uptrend line. So if we break in this area, look for rates to fall down to near 1.25% as the next downside target. Otherwise, you really got to get above, to get a full breakout to me, you've got to get above 1.86% to really get this thing going on the upside. And lastly, let's take a look at the dollar. Dollar hit the 9 up 3 weeks ago, hit the propulsion exhaustion level, which is within this Fibbo box 2 weeks ago, as well as last week. So we've really kind of had this week so far as an inside week of last week. Nothing's really happened yet. If it shoots higher, you look at 98-ish or so as a target. And on the downside, if we come out through the bottom of the box, then look for 93.50-ish or so as first support. So I'm kind of in the camp that the dollar's not going to have a major run higher, but and I'm still willing to be a seller between 96.5 and 98. Okay, let's look at some utilities. We'll start with XLU. Here we go. So the XLU, simply the S&P 500 utility index. So this actually peaked back in early 2020, its all-time highs. It's now kind of testing the August highs from this year. It's got a target up at 70.52. That's $1.50 above current level, as well as 72.5 is the stop out on this 13. This 13, I really wouldn't even pay that much attention to where the stop out is, because this 13 was incredible before things absolutely crashed March of 2020. Bigger long-term upside target at 82.77, support here at 63.15. That's pretty much where we stopped on the way down. If we broke through that properly, you would have had a new bearish propulsion level. It held right against it. So still support at 63 and change. But, you know, this is improving. You have a very gently sloping upward 200-week moving average here, which is well beneath price action. So this is not broken out yet. And anywhere up in here, it still will, in theory, have resistance against its all-time high of 71.10. Let's take a look at utilities versus the S&P. So here's, we've been terribly underperforming since March 2020. Makes a heck of a lot of sense. Market's been flying. Utilities considered very safe type investments that pay out high dividends. And they are not in vogue when the market is flying. So we've had this continual underperformance, even as recently as, where's this first week in November, this made a new multi-year low. So even though it's recovered a little bit since Thanksgiving, you see it's pulling back a little this week, still in a downtrend. The downtrend line got broken off of that high, but this still is, you know, in a week, doesn't matter. I don't care that much about the line as much as kind of just the general slope. Looks like we just tucked above here, but we haven't even gotten back above with any significance what were the lows earlier this year. So negative looking chart. Again, you can buy this sector for, you know, kind of the dividend plays of these and very slow price appreciation, but there's certainly better sectors to be in than this. But let's take a look at some individual charts and see what, if there's any plays here. So, all right, we'll just use this chart. All right, so NextEra, actually on this week now, weekly 9, setup 9, and a 13, looking for exhaustion. We haven't had that in almost 2 years, up against a propulsion exhaustion level. So that's a clue that this is probably not the best time to buy this name. It could continue, but being that we're up against a target that's been in place all year, with the 9 and 13, I'd certainly be cautious about chasing after this. First support would be down around 63.5, no, 83, 84 to 83.5 or so. Longer term upside target all the way up at 112 and change. Duke Energy, chop city here, not nearly as good looking as NextEra was. Peaked on a 13 here back in the spring. Came and held the propulsion. This again would be a bearish breakdown level. If it properly broke beneath, it did not, so double bottom against that. You even actually really have a triple bottom going back to the June lows. So this could still, eke its way higher, just not a great name, but potentially bouncing off the top of its weekly cloud after having gone sideways. So I'll give it a minor upside bias, nothing special. Southern Energies, SO, Southern Company, it's called. You can see the 13s here, aggressive sequential 13 before the huge sell-off in 2020, right here on the top back in the spring, right here back on the top in the summer, has held above where it needs to, is essentially getting a minor bounce off of the top of its cloud, also a minor upside bias here, not anything great, mildly sloped upward slope 200 week moving average. Here's Dominion Energy. This one's even worse, totally flat. Searching for a 13 here. We got to a 12 recently. Could get a 13 in the next couple of weeks. Again, sideways, kind of dead money, not a great name to be in when the rest of the market's flying, unless you really care about the dividend, which some people do and are very happy to take. Exelon, one of the better looking charts here, has made new highs, took out the 2020 high. We remember XLU made its highs back then. This is one of the better names here in the space. Recently even stayed above its baseline from the cloud chart, well above its 200-week moving average. So this is one of the better names in the group if you're looking for one of the ones to be in. Let's look at AEP. Also very sideways. You can see way beneath its all-time highs here from January 2020. But I kind of consider just dead money. Kind of playing with its 200-week moving average for a few months. Actually has a 13 sale here now. So for upside exhaustion, when I see a cloud flip back and forth, positive and negative, it tells you that this is going absolutely nowhere. To me, just no reason at all to consider this name. SRE, Sempra, same type look. It's on a 12 count, totally dead, sideways. To me, just simply no reason to touch the name. Xel, Xcel Energy, also sideways, did make new all-time highs above the 2020 high back a year ago. Has not been able to get above that. We probably even have a little bit of a, let's see, is this still intact? Yep, downtrend line still there. So you got a triangular pattern here. We can use this low versus here. If it breaks out upside, maybe it's worth playing for a move to 74. It's not a bad move. But again, nothing here that grabs me that says, gee, I really want to be in this name. PEG, Public Service Enterprise Group, did make new all-time highs above its early fall 2019 highs. This is pushing, has very little resistance. If you get through 65.95, opens the door for move into the low 70s. So this is actually one of the better ones here. AWK, American Water Works, is on a 13 this week. It wouldn't concern me unless we now get a close less than the close from 4 weeks prior to confirm the 13. So let's assume this week stays at 13. Then I'd potentially think of, if I'm long, I'd stay long and I wouldn't get out unless you had a negative price flip. Again, meaning if you close less than the close from 4 weeks back. And then the last one we'll take a look at today is ES. And ES is Eversource, also complete dead money, sideways. Did at least get a bounce off of its propulsion exhaustion level here. This is a very small one, not really meaningful. You're going to have a larger triangle pattern here to still deal with that it hasn't broken out from. This line really just gets extended to whatever the most recent low was that didn't break it. So it's not all that meaningful, but same thing here. You can see just really not a name worth playing. That's it for this week. I hope you enjoyed the show. I'm Rick Bensignor. Thanks for listening to In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.